Welcome back to Synaptic Dividends. We break down a new dividend stock every single week to help you build your passive income portfolio. If that's your goal, make sure you're subscribed so you don't miss out. So today, we are diving into an absolute titan of the dividend world, Air Products and Chemicals. Now, this is a company that has rewarded its shareholders for decades on end. But today, we've got to ask a tough question. Is this Dividend Aristocrat's incredible 42-year streak of raising its dividend actually in danger? Let's dig in and see what the numbers are really telling us. So to really understand the dilemma here, you first have to appreciate the legend. I mean, we are talking about a company that has earned the very rare title of Dividend Aristocrat. And that entire legend, it is built on this one number, 42. That's 42 consecutive years of dividend increases. Through thick and thin, through multiple recessions, Air Products has consistently, reliably raised its payout. You know, that's the kind of track record that builds incredible trust with investors. And listen, these haven't been tiny, little token increases just to keep the streak alive either. If you look over the last decade, the dividend has grown at a compound rate of 8.5% per year. Now, yeah, growth has slowed down a little bit recently, but that long-term number, that's fantastic for an income portfolio. Okay, so the history is impeccable, but how does this dividend hold up when things get really tough? Well, that's where the legend gets even stronger. Let's take a look at just how crisis-proof this thing really is. I want you to think back to the global financial crisis in 2008, right? The entire global economy was on the brink of collapse. Industrial companies were just getting hammered. So what did Air Products do? They hiked their dividend by a massive 15%. 15. That is a powerful, powerful statement of confidence. And you know what? That 2008 performance, it wasn't a fluke. Fast forward to the COVID-19 pandemic in 2020, another completely unprecedented global shutdown. And again, what happens? Air Products steps up with a huge 13.1% dividend increase. So everything in its history tells us this dividend is an absolute fortress.
But, and this is a big but, this is where our story takes a dramatic turn. Because hiding behind this legendary history, there is a pretty serious cash flow problem brewing right now.
To see it, we have to look at what I consider the single most important dividend safety metric out there, the free cash flow payout ratio. Forget about earnings for a second. Free cash flow. That's the actual real cash a company generates after running its business and reinvesting. So the payout ratio just tells us, hey, what percentage of that real cold hard cash is being used to pay the dividend? Lower is always better. And this right here is where the picture gets alarming. Look, back in 2020 and 2021, the company was already paying out more in dividends than it was generating in free cash, which isn't great. But then from 2022 on, the bottom completely fell out. The free cash flow went negative, and not just a little, deeply negative. So for 3 years running, Air Products has been burning through billions more in cash than it's taking in. You can't pay a dividend with negative cash flow. So the big question is, where is the money coming from? This brings us right to the heart of the matter, the central conflict. How do we square that ironclad history with these scary numbers we're seeing today? This really is a battle between legend and reality. And here it is, the dividend dilemma, laid out plain and simple. On one side, you have the legend, a 42-year growth streak and a dividend that basically laughed in the face of two of the worst financial crises in modern history. But on the other side, you have the current reality. The company is burning cash, its free cash flow is negative, and it's having to use debt to help fund that very dividend. So, which one wins out? Okay, let's put all the pieces together and try to come to a verdict. What should an investor make of all of this? So here's the bottom line. The history is impeccable, and its resilience is proven. That's a given. The reason for this intense cash burn is that the company is spending tens of billions of dollars on these massive new mega projects, mostly in the clean hydrogen space. And what this means is that the dividend safety, it's just not guaranteed by the past anymore. It is now a direct bet on the future success of these enormous and, let's be honest, risky projects. If they pay off big, the cash is going to flow again, and the dividend will be just fine. But if they don't, well, that 42-year streak is in very serious jeopardy. If you want to go deeper and understand the full business model behind these numbers, check out our long-form podcast analyses on our main channel, Synaptic Investing. And of course, if you found this breakdown helpful, a like is always appreciated, and subscribe for more dividend analyses. Thanks for watching.